How to start stock market investing step by step. Stop scrolling because this is where your money journey really starts. Not saving, not working, investing. Because if your money is not growing, it is losing value every single day due to inflation, rising costs, and time. Most people work for money their whole life, but the real goal is to make money work for you the whole life. Let's break it down step by step. Simple, clear, powerful, and long term, because this is not just about starting. This is about building real wealth over time. First, understand this clearly. Stock market is not gambling, and this is where most beginners fail. It is ownership. Where you buy a stock, you are buying a piece of a real company. That means you own a part of business like Apple, Microsoft, Amazon, DZY Network, etc. If those companies grow, increase profits, expand globally, and dominate markets, your investment grow with them. This is how wealth is built, not by guessing, but by owning strong businesses over time. Now, step one, understand your goal, because without a goal, you are just moving money without direction. Ask yourself simple questions. Are you investing for retirement? Are you investing to build long-term wealth? Are you trying to create a passive income? Or are you chasing fast money? Because here's the truth. If your goal is fast money, you will lose. The market punishes impatience. But if your goal is a long-term growth, discipline, and consistency, the market rewards you. The most successful investors think in years, not days. Step two, learn basics, because knowledge protects your money. You don't need to become a financial expert. You just gotta come to the channel to learn. But you must understand the fundamentals. What is a stock? What is a ETF? What is dividend? What is volatility? What is a return? Every investment has a risk. Beginners lose money not because the market is bad, but because they don't understand what they are doing. Education is your first investment. Step three, open a brokerage account. This is your entry point into the market. Platforms like Robinhood, Fidelity Investment allow you to invest easily, and within minutes you can start investing. This step is simple, but many people delay it for months or years. The biggest mistake is not starting. Step four, start with index funds. This is the smartest, the safest strategy for beginners. Instead of trying to pick one winning stock, you invest in entire market. When you invest in it, you are automatically diversified across industries like technology, healthcare, finance, and energy. Historically, the S&P 500 has returned around 7 to 10%. That's why professional investors recommend this strategy for beginners. You are not guessing, you are owning the market. Step 5, invest consistently, not once, not randomly, but every month or every week. This strategy is called dollar cost averaging. It means invest the same amount regularly, regardless of the market conditions. When prices are high, you buy few shares. When prices are down, you buy more shares. Over time, this reduces risk and removes emotion from your decision. You don't try to time the market, because timing the market is one of the hardest things to do, even for professionals. Consistency beats timing. Step 6, think long term, because this is where wealth is really created. Most beginners panic when the market goes down. They sell when the prices drop and buy when prices are high, which is the opposite of what they should do. Real investors understand that the market moves in cycles. There are ups and downs, but over long periods, the market has historically been upward. That is why holding investment for 10, 20, or even 30 years can create exponential growth. Compounding needs time. Step 7, understand risk and control your emotions. The market will go down. That's guaranteed. Sometimes 10% 10%, sometimes 20%, sometimes more. But that does not mean you are losing long term unless you sell. Market drops are part of the system. In fact, many investors see downturns as opportunity to buy at lower prices. Beginners lose money because they react emotionally. Smart investors stay calm, follow the plan, and continue investing. Step 8. Diversify your portfolio. Do not put all your money in one stock, one sector, or one idea. Spread your investments across different industry and assets. That way, if one investment fails, it does not destroy your entire portfolio. Diversification reduces risk and creates stability. This is why index funds are powerful, because they are automatically diversify your money. Step 9. Avoid hype and trends. Social media will show people making fast money. Crypto spikes, meme stocks, and get rich quick strategies. But most of those stories end in losses. If something sounds too easy or too good to be true, it is usually. Step 10. Reinvest your gains, because this is the real secret of wealth. When you earn dividends or profit, don't spend them, reinvest them. Your money makes money, and that new money makes more money. Get to the point now. Over time, this is an effect, and this effect become very powerful. This is how small investment turn to large portfolios. Now, let's make it real with numbers. Imagine you invest $500 every month. That is $6,000 per year. If your investment grow at an average 80% per year, in 10 years, you will have run $19,000. In 20 years, over $300,000. In 30 years, over $700,000. And if you continue longer, it can reach over $1 million. This is not magic. This is consistency, discipline, and time working together. Now, understand the mindset. Do not try to be rich tomorrow. That mindset leads to mistakes, losses, and frustration. Instead, focus on becoming wealthy over time. Wealth is built slowly, but once it grows, it accelerates. Short-term thinking loses money. Long-term thinking builds freedom. Now, let's talk about the biggest mistakes beginners make. Waiting too long because they are afraid. Trying to be perfect before starting. Following trends instead of strategies. Panic selling when the market drops. Not investing consistently. These mistakes are common, but they are avoidable if you follow a simple plan. The best time to start investing was yesterday. The second best time is today. Because every year you wait, you lose time, and time is the most powerful asset in investing. Now, ask yourself this question. If you don't invest, how will your money grow? Savings alone will not make you rich. Inflation will reduce your purchasing power over time. Investing is what allows your money to grow faster than inflation and build real wealth. So, the plan is simple. Start with index funds. Invest consistently every month. Think long term, stay disciplined, ignore noise, reinvest your gains, and repeat the process for years. That is simple but extremely powerful if you follow it. Now, I have a question for you. When are you starting? I just gave you the blueprint. Don't wait tomorrow. Start now.